Welcome to the CPA Quick Review on Inventory. Inventory questions often include calculations, but they also test many important concepts and rules. As you listen, focus on understanding inventory ownership, inventory costing methods, valuation rules, and the situations that commonly appear on the exam. Let's begin with what inventory includes. A retailer's inventory simply consists of goods held for resale. A manufacturer has 3 inventory accounts: raw materials, work in process, and finished goods. Raw materials become work in process becomes finished goods, and when the goods are sold, they become cost of goods sold. Inventory includes all goods for which legal title has passed. Under FOB shipping point, ownership transfers when the goods are shipped, so the buyer includes the goods in inventory once they leave the seller. Under FOB destination, ownership transfers only when the goods are received, so the buyer includes them in inventory only after delivery. There are several special situations the exam likes to test. Consigned goods remain in the consignor's inventory because legal ownership never transfers to the consignee. The consignee simply sells the goods on behalf of the consignor and earns a commission. In a special situation where goods are shipped that do not conform to the contract and the buyer rejects them, ownership returns to the seller, so the seller keeps them in inventory. Sales with mandatory repurchase agreements are generally financing arrangements rather than true sales, so the seller continues to report the inventory. For installment sales, revenue is generally recognized at the time of sale under the accrual basis if collectibility is reasonably assured. If collectibility is not reasonably assured, revenue is recognized only as cash is collected. Now let's discuss what costs are included in inventory. Inventory is initially recorded at cost. Capitalized costs include the purchase price, import duties, non-refundable taxes, insurance during transit, receiving costs, inspection costs, packaging, and freight in, which is the cost of bringing inventory to its intended location and condition for sale. Manufacturing companies also capitalize direct materials, direct labor, and manufacturing overhead. Selling costs, advertising, marketing, freight out, administrative costs, abnormal spoilage, waste, and idle facility costs are expensed immediately rather than included in inventory. There are 2 inventory systems. Under the periodic inventory system, inventory and cost of goods sold are updated only at the end of the period after a physical count. Under the perpetual inventory system, inventory and cost of goods sold are updated continuously after every purchase and every sale. Also remember that under the moving average method, the moving average cost changes only when inventory is purchased, not when inventory is sold. Now let's review inventory cost flow assumptions. Specific identification tracks the actual cost of each individual item and is commonly used for unique or high-value assets such as automobiles, boats, or jewelry. Under first in, first out, the oldest inventory costs are assigned to cost of goods sold first, leaving the newest costs in ending inventory. During periods of rising prices, first in, first out generally results in the lowest cost of goods sold, the highest ending inventory, the highest gross profit, and the highest net income. Under last in, first out, the newest inventory costs are assigned to cost of goods sold first, leaving the oldest costs in ending inventory. During periods of rising prices, last in, first out generally results in the highest cost of goods sold, the lowest ending inventory, the lowest gross profit, and the lowest net income. Because taxable income is generally lower, income taxes are generally lower as well. One important last in, first out concept is liquidation. A liquidation occurs when inventory levels decrease and the company begins selling older inventory layers. Since those older inventory layers were often purchased at lower historical costs, cost of goods sold decreases and net income increases. Another important rule is the last in, first out conformity rule. If a company uses last in, first out for tax reporting, it must also use last in, first out for its financial statements. Dollar value last in. First out measures inventory in dollars rather than individual units. Instead of tracking physical inventory layers, it tracks inventory layers based on total dollar amounts and adjusts for inflation using price indexes. This simplifies inventory accounting for companies with many different inventory items. Next, let's discuss inventory valuation. Inventory is normally reported at historical cost unless its value declines. Companies using first in, first out apply the lower of cost or net realizable value rule. Net realizable value equals the estimated selling price less cost to complete and dispose of the inventory. If net realizable value is lower than cost, inventory is written down to net realizable value. Inventory write-downs are recognized as a loss in the current period and may be included in cost of goods sold or reported separately if the loss is material. Companies using last in, first out, or the retail inventory method apply the lower of cost or market rule. Market is generally replacement cost, but replacement cost cannot exceed the ceiling, which is net realizable value, and cannot be less than the floor, which equals net realizable value minus a normal profit margin. In other words, the market is the middle value of replacement cost, the ceiling, and the floor. After determining the market, compare market to cost and report the lower amount. If inventory is written down under generally accepted accounting principles, the write-down cannot be reversed even if the inventory later recovers in value. Two estimation methods are commonly tested. The gross profit method estimates ending inventory using a historical gross profit percentage and is commonly used for interim financial statements or when inventory has been destroyed by fire, flood, or theft. It cannot replace a physical inventory count for annual financial statements because it is only an estimate. The retail inventory method estimates ending inventory by converting ending inventory at retail to ending inventory at cost, using the cost to retail percentage. Remember, both methods are estimation techniques and do not replace a physical inventory count. Finally, let's finish with a rapid-fire review. FOB shipping point means ownership transfers when shipped. FOB destination means ownership transfers when received. Consigned goods remain in the consignor's inventory. Freight in is capitalized, while freight out is expensed. Manufacturing costs are capitalized, but selling and administrative costs are expensed. Periodic inventory updates at the end of the period. Perpetual inventory updates continuously. The moving average cost changes only when inventory is purchased. First in, first out produces the lowest cost of goods sold, the highest ending inventory, the highest gross profit, and the highest net income during rising prices. Last in, first out produces the highest cost of goods sold, the lowest ending inventory, the lowest gross profit, and the lowest net income during rising prices. Last in, first out liquidation increases income. The inventory cost flow assumption does not have to match the physical flow of inventory. Lower of cost or net realizable value applies to first in, first out, and weighted average. Lower of cost or market applies to last in, first out, and the retail inventory method. Under generally accepted accounting principles, inventory write-downs cannot be reversed, but under international financial reporting standards, reversals are permitted. That concludes the CPA inventory quick review. When solving inventory questions, always determine who owns the inventory first, then identify the inventory system, determine the cost flow assumption, decide whether the question involves inventory costing or inventory valuation, and finally consider whether if inventory write-downs are involved. Once you've identified those concepts, the remaining calculations become much easier. Good luck on your CPA exam, and thank you for listening.